We're back with the commodity report with Kevin Green today. And, talking about commodities, huge move the other day. Of course, as I turn this on, I see my computer's about to die. So, 1 second, guys. One of those days. Um,
Yeah, tell me about it.
so basically, well, on Friday, we basically saw this big give back in the market. So basically, in all the commodities, we saw kind of a big drawdown on Friday. Basically, on a report, next thing you know, everything you see, we got bonds start to head down. We got commodities start to head down. Stocks were kind of flat to slightly down. And then the commodities really gave it up, though. If we're talking about copper, copper was down over 5%, maybe even 6%. I can't remember the exact bottom to end the day, but I know it. I know it. It was it closed at the bottom, nearly the bottom on Friday, and then silver was down 5%. Gold was down. Everything was down. The commodity complex, except for oil. Oil was still up. I think it ended the day slightly down or flat. But oil was the only one that showed any green throughout that day at all. But the rest of it was just kind of took a major hit on Friday. Getting into the 1 month performance, natural gas is up 21%. Cocoa is up 13%, which is pretty interesting. Cocoa gave it back and then bounced. Everybody's talking about the next run in cocoa, and it's like I don't, these things happen for sure. It's not, you can't say a trend is dead. However, this it's going to be a scary one to get back into for anybody because these things commodities tend to go up a lot, and when they go up a lot and they stop, they usually top out at a certain zone. Once it makes that resistance zone or those peaks, most of the time you don't see it past that. That starts to be a level that people can mark off and go, okay, I want to be selling at this zone. You start to see a lot of selling around that zone. We'll see how cocoa ends up, but it's something to pay attention to there. Coffee up 10% for the month. I made a joke the other day, which was coffee's going to be the next cocoa. But it was just to make a joke about it. I really don't think that, but coffee does have some nice fundamentals behind it. Does have a nice trend building. We'll see where coffee ends up, but so far so good. Orange juice is up 7% in a 1 month performance. Nasdaq is up 4.5%. Silver is up 4% over the month. Live cattle, it's interesting because we keep trying seeing this the agricultural commodities start to take a move. Kevin and I have been talking about this move for a while. They start to make a move. Next thing you know, they start to give it back, and the feeder cattle and live cattle continue to lead the way. That's kind of interesting, something to keep paying attention to. They do have pretty good seasonality right now, so we do usually see a seasonal bounce in cattle and the meats at the moment. So that's not too abnormal. So I'm not really betting against the agricultural trade just yet, but I am saying that that's something to pay attention to here. And so at the bottom of the list, we have oats. Oats down 17% in 1 month. Barely anybody in the world trades oats. It's a very hard to trade product for the most part. It really has a lot of volatility sometimes, and most of the time, it's actually there was a funny joke back in the day that old floor traders will tell you is that how do you know somebody went broke in the futures market? They would say because they're trading oats because oats were the smallest contract on the market at that point, and it's basically the last thing any of them really wanted to trade. But if they're trading oats, that's where they're kind of gone broke and everything else, and that's the last thing they're going to trade. But Kevin, what are you seeing? Over the weekend, what did you see on Friday? We talked about a little bit on our other show, but this is where we talk about commodities. So what are you thinking here?
Yeah, so as you kind of talked about, we saw a little bit of a pullback when it comes to the commodities, especially that reflation trade ex crude oil. Now, you can make a case that maybe crude oil was in the near term maybe oversold, right? It touched 72, it went actually below 72.50 briefly. I think it hit 72.44 and some change, right? So seeing a technical balance within the crude market and just the energy patch in general, I think is actually a pretty decent sign. You did see, maybe some rapid selling when it came to the speculators. And maybe we do see a floor here when it comes to crude in the energy patch for now. Now, we still need to have the fundamental data to back it up. We just haven't had that, Jason, right? Like we've continued to see refining and operating rates creep to the upside, which is not abnormal in the summer season, but you would probably say the rate of change from going from what 87% to now we're sitting at what 94.5. I believe that was the last print that we had, 93, 94.5. That rate of change is pretty significant. We continue to see buildups, especially when you're looking at gasoline, right? So I think the market right now is pricing in the fact that maybe we're at some technical oversold levels. Maybe we do see refining rates starting to level out here a little bit because these energy producers have to be able to see and probably do see the fact that the consumer needs to catch up a little bit when it comes to consumption. And in order to be able to tighten up prices, you need to either level off inventories, if you will. I think there's some other optimism too with the non-farm payroll report that we had on Friday, that the economy is still chugging along, not only here, but across the globe, where we had rate cuts from the EU that could also spur manufacturing growth as well, and that could also draw on inventories. And then from the metal space, a pullback in copper. Copper pulled back to $4.44, right? We were looking at $4.50 for an area of support, and when we draw support lines or resistance line, it's not with a pen. You do it with a fat crayon, right? There can be a little bit of a range. A technical bounce today is a good one to be able to see. I'll send you over another chart too, kind of this head and shoulders pattern, a very skewed one to say the least. So we want to be able to hold these levels, break to the upside in order to keep and maintain this uptrend. If we break down and break between this range of say $4.25 to $4.40, that would be your area of concern or your last line in the sand for value buyers that come into this market here. The economic data this week is going to be very, very telling, though. That's going to shift the direction for a lot of these commodities, either to the upside or downside. Now, if you're a commodity trader, what do you want to see? In my opinion, I think as a commodity trader, you probably want to see that reflation narrative, or the inflation continuing to run a little bit hot and bucking the trend from the Fed. Yes, it's going to push back interest rate cuts, but it also, once again, signifies the fact that there's demand that's there and people are still willing to pay for it. And I think that gives you a longer term picture rather than a rate cut, which could signify that we may have an economic slowing, and that signal might be a little bit bearish in the longer term. And when I say longer term, over the next 8 months, 9 months for the commodity patch. So those are kind of the areas. We're seeing some technical buying coming in today. Maybe we hit some oversold levels on Friday, seeing some buyers step in. But a lot of this economic data is really going to shift these markets, in my opinion, for this week, and rightfully so. What do you think?
No, I agree. Sorry, I didn't see your oil chart until I posted mine.
Oh, it's all good.
We go back.
No, yeah, do you? Yeah, you do whatever you gotta do.
But yeah, but I've got them all in there now. So whenever you want to get to the stuff, we could do that soon. But yeah, no, I'm seeing the same thing. We talked about this last week, and this was on Friday. We talked about copper and the major zone of support. And why I'm drawing this line like this, it isn't exactly, once again, we talked about this the other day. You want to draw a big line. My time frame, I draw a very fat line. The reason is, if you talk to old traders before there was charts to this level, they would basically take a ruler, and wherever the most lines hit, that's basically where the price would retrace to. Nowadays, we have a tool called volume by price. You could have an open interest tool, which is another tool we use on Trading Technology for futures. But open interest basically puts it at this zone. We saw us briefly dip into this zone, and now we're kind of coming out of it. So, to me, we could move lower here, or we could bounce right here. I could see two different ways of this moving out of this pattern pretty easily. However, the one thing I wouldn't want to do is, until this really clears some sort of MA, 10 EMA, something, I wouldn't want to say, hey, I'm just going to start buying right here, thinking it's going to go up. We do have a long position still. It's pulled back quite a bit, but it's still very profitable at the moment. I'm still looking for, and I think the most probable outcome that Kevin and I have talked about a bunch, is a range here. As this kind of comes into a range, I think that's what we're going to see. And then maybe we start to see other commodities start to catch up, if that's going to happen. And once again, we came up with two ideas last week. And one of the ideas was, okay, this comes to this zone, it bounces, it moves right back up. and just kind of carves out this range that's possibly a bull flag to move higher. And then there's the other thing that we can think about here, and that's what if it just starts breaking down and crashing? Now, that's another thing to pay attention to. And this is what you want to do as a macro trader, as a commodities trader, or futures trader. You want to mark off all these levels and understand that if we start to get below these levels, that's when something significant is building. That's when something might be changing. And so if something's really changing in the market, we have to be open to the fact that if copper is breaking down and let's say oil turns back down, that's telling us something. Right now, oil's trying to move up, and copper's trying to move up as well. So we'll see where that ends up. I'm still in the boat where I think commodity prices could still head up. However, I don't have the fundamental picture to really say that yet. And I don't see the price action also telling me that either. So at the moment, I'm just very neutral on most of these. I still think precious metals are probably a good place to be. Copper, however, oil, they need to do a little bit more work here for me to get more bullish on this.
Yeah, we talked about, all right, so let me hit copper real quick. So for copper, if you're looking at the commitment of traders, net change, we did see some sellers coming in, right? The net change last week was 2,900. Man, this is a Monday. 2,793 contracts shorting the shorting copper, right? Which is not surprising, right? We talked about this situation where speculators kind of have taken over the flows there. Let the speculators wash out. Once you start seeing week over week prints where we have net changes of pretty much zero, I wouldn't say it's going to be exactly zero, guys, but if you start seeing the deceleration of these net changes either to the upside or downside and kind of starting to level out or range out, that's when you can kind of say, okay, we may have an indication that we are at a near-term bottom here. We got the speculators out. The speculators want to party and trade something else. Is it going to be uranium? Is it going to be platinum? Is it going to be whatever it is, right? Get them out of the copper trade, and then we can see the proper equilibrium as far as price. I'm right there with you, right? Like, you want to see a bounce off of that range, but it's not the only thing. Like, it's not like you break that and then we're just like dead in the water. We talked about the fact that copper on a longer term time frame triple tops or does triple bottoms. It's probably the only contract that I've seen that actually does that on a religiously, right, over years. If you're looking at the last 20 years, 30 years, it's pretty much known for that. And so sometimes if you get speculators in this market, they might be they usually will get faked out first, right? Because they're just not used to seeing those type of trends. Let's see if that's going to be able to develop there. I think the China demand story is going to be also key, and I think we're going to get some economic data from them this week regarding copper that I think is going to be very telling, to say the least there. But I wanted to go over that. Let's look at that crude chart, if we can bring that up. So last week we talked about the fact that, hey, we're hitting this 200-week moving average. Now this is going to be a daily chart. I usually bring weekly charts. The daily chart, I really wanted to kind of illustrate this. We could see technical bounces coming off the 200-week moving average, and that's pretty much what we are seeing, or that type of reaction, what we are seeing from Friday as well as for today, right? So I have two channel lines here. Let's just say this, right? The beginning of the year, what's your primary trend? Technically, it's only by a couple of weeks, right? But technically, the primary trend is still up, right? That's going to be the yellow, technically. But you are seeing a major pullback, right? This is kind of being more than just a bull flag. This is kind of showing that reversal pattern, or maybe we see this type of head and shoulders scenario playing out on the daily, which we are seeing. So the white is the intermediate time for intermediate trend, which is downside. Yellow, primary trend. If you're looking at the start of this year, just notice that we have that confluence. When those lines start to align up, as you kind of talked about, that would be kind of like your area resistance zones to be focusing on, which would be around $80 to the upside there, right? So let's see if that technical bounce is going to take place. If we do, then expect resistance at around $78. I think I talked about it last week. I know I talked about it this morning on a space. 77 is kind of my area of resistance that I'm looking at. And honestly, we're only 8 cents away from there. So can we go higher? Yeah, for sure. I tend to be a little bit more conservative when it comes to my technical analysis, my expectations, right? Keep your bar very low. And if you exceed that bar, then everything else is just icing on the cake here. There were some political geopolitical things that happened over the weekend, especially when it comes to Israel and there were some Iraqi militants that hit a very key base. Somebody asked me, and I didn't respond back yet. I got to do that today. But somebody asked me, hey, is this going to be a catalyst move for crude? I don't think that's actually what's happening today. I think we're just seeing some technical buying. Until you actually start hearing Israel actually targeting oil infrastructure, I don't think that's going to go anywhere anymore. There's no geopolitical war premium being priced in for the most part for crude anymore, right? We've got to put that aside. But I just wanted to kind of bring this up because notice that lower channel line on that yellow on the yellow channel, right? As we were moving to the upside, notice when we broke down, that area of support now turned into resistance, and it was a resistance zone for about 2 weeks before you saw that breakdown to the downside. That's not what you really want to see if you are a bull, but if you see this little flag pattern and you're able to overcome or be able to retake that particular level, which once again, 79.50, I say $80. You can overtake $80 and recapture that primary trend, then that's going to be ultimately bullish. I would also say though too, I bring up heating oil a lot. And Jason, when we look at extremes, and we talk about extremes all the time, right? Sometimes when markets get completely oversold, you don't want to try to call a bottom by any stretch of the imagination, but you can always make a case that maybe we do see a structural reversal, or when we do see a structural reversal, you can see power trends in those oversold contracts or those oversold markets a lot easier than maybe the primary market, which I would consider to be crude oil. So I'm still keeping my eye out on heating oil, not making a call here. But at some point, if you're kind of going with the macro narrative that we are pretty much in a recessionary territory when it comes to transportation, freight transportation, keywords there. If that is going to be the case, then how worse can it get from here? It's kind of the scenario. You don't want to ever catch a falling knife, but it is approaching some areas where I would say, okay, do we bounce off at $2.26 for heating oil or diesel? We use those interchangeably. We're really close there. We're only 2 cents away, and it's a key area of support. Are we seeing a technical bounce right now? And then are we going to be able to see outperformance from heating oil compared to crude oil? We're not seeing that today, but is that something that's going to happen in the near term? I think that's something I'm keeping my eye out on. So let me crude for the positioning here. I gotta get crude. Where you at? Okay, crude. We saw net contract change negative 20,290. So basically short positions layering into the market, or those that were long were buying back those contracts. So that's what we saw last week when it came to positioning for crude.
Yeah, I'm looking at that right now. It's interesting because we have a rate of change model basically that measures the commercials against the speculators, and we're actually getting back into a bullish bounce territory for crude, which last time that happened, that was at the beginning of the year. We got a nice run after that. So once again, once we start to see that, but we need to see that continue to step up. You know, we're seeing those levels start to move up, like Kevin said. We need to see that start to step up to a level that is going to create a sustainable trend. We're just not seeing that just yet. So these fundamentals, like, they're kind of building. I think that's a good way to kind of think about what we're kind of saying here. The fundamentals here are building. We're kind of getting to a level that could see a rally, but once again, we're not quite there just yet. So we keep going back to it's kind of a wait and see. But looking at levels, like Kevin said, you know, short-term levels, looking at the next one and the next one. For me, something that's also important to talk about when we're looking at something like crude oil, and we're seeing, you know, for me, one of my favorite patterns, anybody who's been following me for years will know this, but one of my favorite patterns is the false breakdown pattern. Basically, if we look at a chart of crude and we see let's go to Kevin's chart, I think would be the better one here. So we're seeing that crude in the front month contract is getting above those levels right now. So that level is $76 even, actually. After we get above those levels, that creates a false breakdown signal. For me, one of my favorite patterns to look at is a false breakdown signal, because most of the time, technical analysis, and this is anybody who looks at charts knows this. It's not a objective science; it's a subjective science. So when we're looking at it as a subjective thing, you would go, okay, well, you start trading, you start looking at technicals, you find a pattern called a head and shoulders pattern. You go, that means it's going to fall and this is going to crash. But let's say this is in an uptrend, and then you see a head and shoulders pattern. And let's say it breaks that neckline on a head and shoulders pattern. And then it gets right back above that neckline. Sometimes that's going to be some of the best trades you'll ever see in your life. If you go back to 2020, middle of that year, this is probably September, October, going into November, you saw that pattern again and again and again. You saw it in oil. Yes, it wasn't perfect head and shoulders every time, but I'm saying a range pattern, breakdown, move back up. You saw it in the S&P 500. You saw it in oil. You saw it in different sectors, crypto. Just across the board, you saw it in a lot of different places. And what that really says is sometimes the best way to look at technical analysis is look at the chart. If it breaks that level, great. You can short. That doesn't mean you can't. But when it gets back above that level, you absolutely have to get out. And especially if you're doing something that's in an uptrend. Oil isn't really in an uptrend or a downtrend at the moment if you look at a very long-term chart. However, so I'm not going to have more of a crazy bullish bias on it. But if it breaks this level and then we get a close up here today above 76, and we get a good close here, strong close, like where we're at, basically 76.84 in the front month contract. If we see that point, I would be a little bit more bullish on it, making it back to $80. And then maybe after that, 85. And so, like Kevin said, taking it small pieces at a time. I'm a trend trader. So once we're in a trade, we're looking for it to just go and go and go. When I get an exit signal, I'll be out. But I do think that's something to pay attention to, is breaking a major level, reclaiming that level. Even if it reclaimed 80, that would be very bullish for me. I would say above 80, a close above all those highs that are around. Let me look at that. I have it up here, so if I can get my other screen to move, right? Above 80.78. 80.78 are the old highs. So if we get above that 80.78, that were the highs from May, I'd be a little bit more bullish on it.
Yeah, I'm just checking the Okay, so
how's the curve looking? Actually, that's
the curve's looking good. What I'm trying to see here. Okay, so we got 10 days left for the active July contract. So you are kind of seeing some rolls taking place too. And you sent me a chart offline the other day when you're looking at natural gas and the effects that rolls can have on a contract, right? Selling out, buying back. So we could also be seeing some residuals of that happening as well, getting out of July. Going into we might see a little bit of a split though, right? So you might see going to July and then going into August contract, which will be front month active. And then also September, because that September contract is actually one that's really heavily traded, because you start to get the seasonal shift, right? The seasonal trades shift where we have pretty much you're at peak demand driving season. What is that? Labor Day starts to come up. I think it's Labor Day. That's kind of like your end of your driving season. So a lot of activity there. And then you get prepared for the winter months where you expect lower refining operating rates and potentially build up in certain respects, but it just depends on how quickly they're going to start drawing down. So we could be seeing the residuals of that. The front month active is still July, technically. That's where the volume is at right now, but just kind of be mindful that we will be seeing some rolls. We are actually now trading at $77.10 on that. So it's trucking higher, man. And once again, kind of, if we can bring that chart up again, how many times have we touched the upper and lower channel lines, right? On that white line. And when you only need 2 points to make a trend line, right? That doesn't mean it's going to be the best trend line when you make those points. I like to have at least 3 to make a solid trend that I believe in. But let's say you take 2 points, you extend those out, and let's say that it does hit like we do have at the bottom there. It does hit that. We've had upper channel line hit 3 times. We've had the lower channel lines hit 3 times. If you're talking about the cycle, what is that? What can you infer there? Hey, this thing's intact.
Mhm.
And if it's intact, can we see a bounce back move up to $79? Yeah, we could.
Mhm.
What's also still intact, though, the downside move too. So if we are seeing this range bound market, you can kind of see these swings, and that's why I say I'm just a little bit more conservative. I look at 50% retracement levels within a channel for my degree of confidence, even though you can see it goes a little bit higher. So that's kind of where we're at right now. And if we have some good economic data, I think that can continue to push higher. Just be kind of mindful though. Jason, you brought up, we're in a lull right now when it comes to the fundamental data for the energy markets as a whole, right?
Yeah.
India has kind of slowed down when it comes to their energy consumption. Now they had a pretty significant ramp up, and then they're also, purchasing. There's the assumption that they're purchasing stuff black market too, right? So a lot of their data might not be reflected because they're getting some of this crude pseudo from Russia through transferring of tankers out in Greece and all that stuff, right? So that could be the case. And then Japan, we're really in a rock and a hard place because the currency side. So no one really knows exactly what's happening out there. We don't have the full data yet. And then for China, where are they at when it comes to their purchases? Are they leveling out? Is it the same type of scenario that we saw for gold last month, where gold purchases for their central bank, they didn't have any? First time in a very long time, I believe like in 20 years, right? They didn't do anything. And price is going up too. So until we get the fundamental data to really back up the price action, you assume that we are in range bound territory and you respect the trends until you see otherwise. You brought up basically breakout strategies.
Mhm.
I'm going to go on the other side. And I'll just say personally, I hate breakouts.
Most people
I hate them because you know why? Every time it seems like I buy one, it fails. And then when I don't buy a breakout, when I don't buy the breakout, it actually then breaks on a strong volume. They're very hard when you try to buy tops and breaks, but you have to respect the price action and you trade the way that you feel comfortable with. And there's all types of ways to be able to kind of trade and look at setups. So breakouts are really, if you kind of go back, if you think about it just holistically yourself, what's probably been more profitable over the long term, breakout trading or trying to find bottoms in markets? And most of the time it's going to be breakouts, right? Because stocks especially tend to break out in range and trend higher, whereas stocks that are usually in downtrends remain in downtrends until something fundamentally changes. So you kind of catch a lot of falling knives trying to catch bottoms. But sometimes when you look at a chart that is bottoming, you feel a little bit more comfortable. Like, all right, like how lower can this thing go? Right? How lower can this thing go? Rather than like an Nvidia type move, and you're like, all right, it's at 1200. We're gonna do 15.
Some things get long in the tooth.
Yeah,
that's all. I mean, it's a hard thing about breakout trading, right? Is not because it works well and makes money. It does. It works well and makes money, but can you handle the pain? Because the way to do it really is, okay, you have let's say a 100-day high, just to make it simple. You have a 100-day high signal. You can take that trade, but just so you know, most breakouts fail. And if most breakouts fail, even though they work, even though the strategy works, you could be underwater for months, So it just, I think more than anything, breakouts really depend on time frame. If I'm trading a good breakout strategy, I have to understand that I might be in that trade for a very long time. Look at natural gas, for example. We had our false breakdown model. It broke down, gave us a breakout signal, and then it was underwater for 2.5 months, I think, or something like that, but then it broke out again, continued higher, ended up creating a new trend. It's very profitable, but it's very frustrating. I think also another thing, and it's not, Kevin was mentioning stocks tend to be in trends up and down. And individual stocks, yes, but if you look at something, and this is because of the way they're weighted, so individual stocks, absolutely. But if you look at like the S&P 500 and you buy the SPY, or you buy one of the big ETFs, you basically can trade a mean reversion strategy very profitably, sometimes even better. And also,
Yeah.
what's really interesting too to think about, and Pavel and I were just on talking about this. We have a new interview on my page if you guys want to check it out. We were talking about mean reversion strategies against breakout strategies. Breakout strategies are very profitable. However, you will be in a drawdown a lot, but they're more profitable. Mean reversion strategies, you'll be in a drawdown a lot less. Your returns will be a lot smoother. I recommend, and what we do is we use both. We use mean reversion strategies and breakout strategies in ETFs, stocks, and so on. And this also helps to smooth your returns when you're at those frustration points, because breakout trading is cool and it makes money. However, there's plenty of times where you're like, this sucks. I'm sitting here buying breakouts and they're all failing for months. You know, that this happens. Not every trade will fail, but I'm saying you'll get into a phase where you'll get 4 that work and then you'll have 5 that don't. And this happens all the time. So the mean reversion strategy will kind of help to smooth out your returns. So I think using a mixture of both is great, but it also has to really depend on your time frame. Shorter term traders, Kevin will trade, intraday, very short term stuff too. So shorter term traders, I think it's even easier to trade those major mean reversion setups, which is good, something to keep in mind for everybody, because I really think trading really comes down to risk management, but also understanding your time frame. I understand my time frame is very long, therefore breakouts work, therefore frustration is just part of my life, and I'm okay with it.
It's just like, dude, here's the thing for me, right? When there's a breakout there, this is just in my head, right? Because there's a lot of great breakout traders that just boom, and then when they trend and they rip hard. They have trailing stops set up, and they just kind of like, they take off a couple of contracts. They keep runners. We hear about runners all the time. You keep your runners on there and you just go. But every time for me, man, it's kind of like I'm buying a top. like let me just say, I'm good. I'm the guy that's taking the liquidity, or I am the guy providing the liquidity for somebody else. It's like, got him. Like you're at your peak, bro. Like, gotcha.
I just think it's so much of like just understanding that about yourself. Like what you just said is important, because now it's like I just understand that about myself. Like I understand for me, like what I do and the frustrations around it, and like I understand like for other people it's like I can't do that exactly, but there's other ways to do that, where you're like, buying something, let's say like your market bottom. And a great one is the market bottom that happened in 2020. If you looked at semiconductors, gold, technology across the board, you basically saw this major relative strength come in. And when you see this major relative strength come in, you can still buy bottoms, but you'd buy it in areas that are showing relative strength. And usually those are the next ones that are the outperformers. I always mention on like corrections, the best thing to do is sit back and see what's the strongest sectors in the correction. And that's usually going to be the best short-term trade going forward. So, I mean, I think there's so many different ways to trade, as you said at the beginning, there's so many different ways to trade this market. And the more the everybody having different views only helps everybody else kind of understand each other's views. It's fun to chat about. It's fun to learn about different people and different things. Some people think I'm a psychopath because of the way I trade. It's cool to have those conversations.
But you have more time. You have time on your side, right? Over the long term, if you have time on your side, you have the higher probability of being right on a particular trade, right? Like even if you're trading options, and I know we're veering off from commodities, but even options, you rarely hear somebody that trades leaps complain about losses in the market, because they're buying time, right? And they're able to sell premium against it. But you rarely hear somebody that says, oh yeah, I bought something that's 2 years out. I think this is going to be a trend here. You rarely hear, oh man, that trade busted. Because eventually at some point, for the most part, from what I've seen, they're going to have the probability of something hitting in their favor is a lot higher than somebody doing something that's a little bit more short term, right? So time on your side gives you a little bit more favor. Will you have the returns of somebody that's trading something lower with a lot less time, right? Like if you and I went head to head in a duel on a 1 week basis, and you kept your portfolio the way it is right now, and I matched your portfolio, right? But I used all options that were, let's just say, even at the money, and I used to use all levered options that were expiring this Friday, and I matched your return, and I matched yours. You see what I'm saying, right?
Yeah.
I have less time, but you had the leverage to the upside, but you also.
I was just saying that you're dead. Like you're dead in the water. Like that's that would be so hard to do. And that's the kind of
I will say not do it. I'm just using it as an example. I just want to let me make it really abundantly clear. I'm just using that as an example.
No, I'm just saying that's a great example. The best example. Yeah.
You can blow up really quick. And so you have time on your side. So that's where you benefit more than most that trade intraday or even do swing trades for 1 or 2 trading sessions. I did want to correct myself. The utilization rates right now is sitting at 92.9%. I think I said 94. So my apologies on that. I wanted to clarify. Actually, I am actually very curious for those that are watching, whether on X, Twitter, on wherever else this is streaming on YouTube. I'm curious, do you like trading breakouts or not? Because I know some people don't, some people do. And I would love to hear why or why not. That would be pretty cool. To be able to get some responses from others and how they like to trade and look at the markets.
Yeah, I love that because it's generally like hated. So breakouts are generally hated. But I also know like it's a thing. Like when you talk to traders, it's like somebody brought up in our group. I think it was Blake or Myron. There was the Trader Journey, and he was talking about he compared it to some book, and it was the Trader Journey. And it was a really cool way of talking about it, which was like, you go from this short-term time frame and you kind of move on to longer-term time frames. And like, basically I was like, at this point I've been trading a while. I guess I'm just kind of getting old in the markets, but my time frame started out very short too. Like I was, you start out thinking, it's, and some people do it well. I just never learned to do it well in that short-term time frame. And also think about it this way. If I'm an unlevered, now I'm levered, so this isn't me, but let's say I'm an unlevered trader, and I'm just trading, the S&P 500, the NASDAQ, maybe XLE, and then I have this 1 year time frame. If I say even today, the NASDAQ will end up higher by the end of the year, most likely I'm right. Most likely I'm right. Not saying like I will be right, just saying most likely the probabilities are on my side. But if you take that time frame and you change it, it moves down. So, I like the way you said that because it's important to understand that and then understand like, well, if I am going to trade this short-term time frame, how do I do it? And that's where Kevin kind of gets into what he's doing. He's illustrating that short-term time frame. I'm trying to illustrate that longer-term time frame. And we explain this a lot, but I think it's important to explain so traders can do that. So please write us, let us know what you guys think about breakout, buying bottoms, mean reversion. Let us know what traders you are. So Kevin, you sent a chart of the dollar.
Yeah, we can do some rapid. Look, all right. So last week I was like, hey, I think the dollar is going to break down. I think some of these other currencies are going to gain in value, right? And that was right to a point. I didn't expect that we were going to have the jobs over that we did have on Friday. So we are seeing a little bit of reversal, but we have this this triangle that is continuing to develop. And Jason, if we kind of look at it over a longer time frame, we're getting close to an apex, but that still could be 4 months out until we actually have this apex. So what are we kind of looking at this week? All right, if we have this kind of reversal in the dollar and the dollar is actually gaining some strength, keep your eyes out on what's going to happen with silver and also what's going to happen with gold. Traditionally, weaker dollar, stronger commodity prices, especially when you're looking at the metals. There's like an inverse relationship that is there. Do we see a bounce back? Do the metals even care? I think that's another good question as well. When you're looking at the gold positioning, and the reason why I brought the dollar up, when you're looking at the gold positioning and the silver positioning, silver net longs, they're still relatively fairly strong. I believe we are at 2020 levels when it comes to the net longs for silver right now, and gold is on a similar fashion. So even though we had that price movement to the downside last week, and mind you, the commitment of traders report shows everything that happened up until Tuesday's trading session. So we don't see anything that happened on Wednesday, Thursday, or Friday. But just to kind of go back and say, look, there's still a lot of long positions being held in the futures contracts for silver, for for gold, and will we see those buyers kind of stepping in regardless of what the dollar does? And what is the dollar going to do this week if we do have some dovish commentary that comes out from Jerome Powell? I think that's the biggest question mark that I have right now when looking at that dollar. I still believe that the dollar will break. I feel like, can we bring the chart up again real quick? When you're kind of looking at this chart setup, right? When we bounce to the upside, it's on some strength. We have a lot of strength there. You can actually see the volume. We don't have the volume on this because it's the actual index, but there is dollar futures. You can kind of see some volume. But when you're seeing these pullbacks, these consolidation phases then breaking to the downside, I think are very telling. Now, we had a consolidation phase for the last, 2 weeks, 3 weeks. Consolidated, broke to the upside, really didn't test that lower channel line. So are we seeing a reversal or not? If we power higher and we keep going above these particular levels, then look to test that upper channel line and see some resistance there. I just find it very hard to say that, knowing what we have going for us right now. Now, we are also seeing some dollar strength because of some elections that we had over the weekend. When you're looking at France, it sounds like they're going to be, Macron is looking for a snap election because the Liberal Party there just got trounced over the weekend. And then when you're looking at the UK, I think they're seeing some struggles there. Or they're seeing a power shift, if you will. So election uncertainty can cause the dollar to strengthen. Election uncertainty overseas. We have an election coming up in November. So what's that election uncertainty going to show for us if we kind of hear some of this rhetoric that I think everybody's kind of expecting that we will see probably some fireworks, no matter what side of the aisle you're on, you're kind of preparing for that. Is that going to create some dollar weakness as well? And is that going to be a catalyst for commodities moving forward? But once again, a nice bounce, move back to the upside on the dollar. I don't know how long that's going to hold. And I'm a little skeptical of the move. And if we see a strengthening dollar, what does that mean for commodities? I think that's going to be still a little bit of a headwind for them, but maybe not. Maybe not. I actually had another chart too. Yeah, what are your thoughts on that? And I had another chart on.
Yeah, the meats. Yeah.
Yeah, just wild card. Let me throw a wild card chart in there.
I like that. I mean, once again, we're in commodities. So it's commodities. It is the place where most people aren't paying attention to. However, a lot of money's to be made in the meats, and nobody ever wants to trade them.
Yes, and then mind you, it's a Monday, and I'm on 3 hours of sleep right now. So
you're doing great. You're doing
all
great.
Right.
You're doing great. So yeah, but the dollar, I agree. I agree with the bounce we're seeing. You know, once again, you have to be very objective when you're looking at the dollar. There's so many things that go into it, and once again, it's always the Fed. On Wednesday, see a dovish report. I completely agree. That could put some pressure on the dollar, and once again, the rest of the world's cutting rates. So what is the dollar for you guys listening? The dollar is weighted against the euro. The dollar is weighted against the yen. The dollar. Mainly the euro. So as long as we see rates dropping in Europe quicker than they are in the United States, most of the time we'll see the dollar have some strength there. But right now, if we get into a situation where they start to talk about cutting rates, they start to act very dovish, I do think the dollar will have some pressure on it. However, watch those zones that you labeled here. I really like those zones. Watch these breakout levels. We start to hit these old highs. We start to break right through them. That will tell us something, and that'll say, okay, well, maybe the dollar's headed higher here. Let's say we start to break down. Dollar's most likely headed lower. Right now, that's the hardest thing to do with ranges, is kind of be objective at that point and go, I don't know anything right now.
Yeah.
That when something is in a range until we really see a decisive breakout. What I do like is that the volatility is tightening. We're kind of getting into the squeeze pattern. One way or another, it's going to move, and it's probably going to not be a small move. And, newer traders might say, well, what does that matter? You're not telling me a direction. It does matter, because low volatility leads to high volatility. And so when we're seeing that, we can be prepared to buy that breakout or sell that breakdown. And if it's a dollar and you don't trade the dollar, be prepared for some pressure on commodities possibly happening if we get above that major level that Kevin listed, and some pressure being off of commodities if we start to break down on that other level. So that could be a couple things to just kind of pay attention to. So let's hop into this last chart you brought before you got to go, and I think we got to go in a little bit. I have to go too. So we got weekly cattle slaughter, weekly beef production, weekly dressed cattle weights. So let's do it. And this is great for me because I trade these things. I think they're great products, so I'm down.
Yeah. So one, this is not my chart. This is coming from the Hightower report, which I do recommend. Like they're one of the best futures research firms that are out there. It's a very small operation out of Chicago, but they do some really good work here. All right. Here's the thing, right? So we have weekly cattle slaughter, if you will. It's on the primary trend. That's going to be a top left chart, if you will. So it's the primary trend. We're going to see slaughter rates kind of continuing to increase over the June and July months. See a little small drop in July, and then kind of ranging out from there. Not surprising. This is usually when we see a fair amount of healthy demand, barbecue season, all of that, right? We also have kind of the H1, whatever that the new variant is for bird flu. Honestly, I'm starting to lose track for all of this stuff, but there's a little bit of concern, especially when it comes to dairy cows and the impact that it could have on demand there, especially export demand. So I think there's been a little bit of pressure to the downside. There's also been a little bit of concern about weights for these cattle. But Jason, if we look at that bottom chart, that's your dressed weights for cattle.
Yeah.
And they're not following any type of trend. You would think that we did not have a bird flu scenario that is actually hurting, or I want to say hurting, impacting weights for cattle. Now, it's suspected that it only impacts them for like 2 weeks, 3 weeks, especially if they get on antibiotics. It should be good. But man, rapid spike, complete divergence, what we have seen from the 5-year average, which is that blue line at the bottom, and what we saw last year. We are seeing heavy weights in the cattle sector, and that is going to push down prices even more. Even though we are seeing demand, for the most part, still stay at a fairly relatively healthy level, right? And so keep your eye out on that divergence. Are we going to see this kind of rounding scenario where weights start to go down in a seasonal pattern in September or in October where they should be going up? Or will we see weights continuing to go up? And if that's going to be the case, that should provide downward pressure on cattle futures. Now, we had a contract change taking place today as well. So you're seeing some of this rotation. Cattle futures are up about 1.5%. But once again, kind of a rotational factor that's taking place. But I found that to be actually fairly remarkable. And beef production is going to be obviously increasing and kind of peaking out here between June and July. But these three charts kind of signify slaughter, pretty much 5-year average, no trend change there. Beef production in general, 5-year average, no change there, but dressed cattle weights, remarkable divergence. And I'm not sure if the market's probably priced that in yet. Export demand is still kind of there. So I think this is just a really good illustration how things can change and things don't really have to follow the seasonal trends. Sometimes these developments do happen, and we have actually some favorable weather events too. So when you're looking at grass-fed beef, the grass is growing pretty much across the board. We're pretty much out of a lot of the key drought areas that we were concerned about at the beginning of the year. That has really subsided. That's also going to help out when you're looking at weight. Whereas the last couple of years, we've been in drought conditions, especially here in the Western Plains, if you will, and that has impacted cattle weights. We're not seeing that this year.
No, I love that. It's a great chart. And honestly, if we just look at the charts of feeder cattle, feeder cattle for us, it was in a great uptrend to start the year. We ended up getting stopped out of that. It re-entered the uptrend pretty recently. Once again, it's got a lot of reasons to be bullish and a lot of reasons to be bearish on it. I like what you brought up there because that's something that hasn't been on my radar either. So, once again, we are seeing commercials continue to buy these things. I wonder if that's just fear of bird flu, all the media, what's going on with that. Because really, like what you're showing is a little bit different. So that's a good thing to see.
Well, that is a divergence. So let's clarify that. There's a difference between feeder cattle and live cattle, right? So feeder are the smaller like calves, right?
Yeah.
That you're going to be raising up. The demand there is very high.
Mm-hmm.
The demand there has been very high and continues to be very high because of the fear of this virus happening. We also kind of have to keep in mind too, and we forgot about this out of the news cycle, but we did have a significant fire that took place in Texas that actually impacted a fair amount of grass-fed cattle that were out
We
there
meant
as
to
well.
talk about that too. Yeah.
Yeah. So there's still a fair amount of demand on the feeder side. And we just anecdotally, I mean, we have guys that are going in auctions and just like killing the game when it comes to profitability off a feeder. So they don't move in tandem all the time. We can have these divergences taking place. And I think that's kind of what we're seeing right now. But the dressed weights, man, I am
That's stunning.
shocked by that.
That's a stunning chart, and that's kind of just saying something very different from what I've been thinking, what most of media has been thinking. Honestly,
Yeah.
like it's very interesting. So I'm glad you brought that up. We'll end it right there. Thanks for coming on, Kevin. This is a lot of fun, and you guys can tune in with us every week. We're on at 11 or noon, depending on the time, but we're here every single week on Monday around 11 or noon. All right, guys, we'll see you.